Very good morning, my dear friends. We are in the chapter Amalgamation. So almost we completed 3 lectures. I think so. This is the last lecture for the chapter Amalgamation, probably. So because we are almost having total 9 lectures for entire 3 chapters. We already dedicated 3 lectures. This is the 4th lecture we are doing actually. Okay. So hopefully we will try to complete Amalgamation chapter in this lecture. So right, in the last lecture, we started the concept of amalgamation in the nature of merger. The difference between amalgamation in the nature of purchase and amalgamation in the nature of merger is all assets and liabilities taken over by the purchasing company, and all such assets and liabilities are also taken over at book values. Along with assets and liabilities, purchasing company will also take in over reserves and surplus of the selling company. But in case of purchase method, purchasing company will not take over reserves and surplus of the selling company. That is the primary difference you have to remember in your mind. Okay. Then we will compare purchase consideration with net asset value of the business takeover, right? The first entry is the as usual entry, business purchase account to liquidator of selling company at the rate of purchase consideration. Then we decided in the last class, sir, in case of amalgamation in the nature of merger, purchase consideration is nothing but, purchase consideration will not impact the method of amalgamation. The PC may be net asset value method, or PC may be net payments method, or PC may be intrinsic value method, or PC may be lump sum method. It is in the as usual manner only. The type of amalgamation will not impact method of PC. Okay. But at the time of incorporation of assets and liabilities, you need to compare purchase consideration with net asset value of the business takeover. Sir, purchase consideration means we will calculate from our end by applying a suitable method. What about net asset value of the business takeover? If you observe here, the NAV of the selling company is nothing but total assets minus total liabilities minus reserves and surplus. Then automatically the NAV of the selling company would become share capital of the selling company. NAV of the selling company would become share capital of the selling company. To put it in very simple manner, while comparing PC with NAV, what you will compare? Number of shares issued, because in case of amalgamation in the nature of merger, the entire PC in the form of fully paid up equity shares. So the worth of equity shares issued by the purchasing company to the selling company is going to compare with face value of the share capital of the selling company. If the worth of the equity shares going to issue, that is nothing but PC, is greater than NAV, then what are the consequences or what are the adjustment to be made from purchasing company angle? Or if the purchase consideration is less than NAV, I mean to say the worth of shares going to issue in the form of PC is less than the share capital of the selling company, what are the adjustment need to be done? Now concentrate. Sir, in case of amalgamation in the nature of purchase, if PC is less than NAV, which adjustment you made? You treat it as a capital reserve, right? Here also we are treating it as a capital reserve. There is no difference. Amalgamation in the nature of purchase, if PC is less than NAV, you are paying very less amount, but you are getting more benefit. Then such profit simply you are transferred to capital reserve. Whether amalgamation in the nature of purchase or amalgamation in the nature of merger, that is the same treatment. But coming here, if PC is greater than NAV, then the accounting treatment is quite different here. Now all of you please concentrate. If purchase consideration is greater than NAV, which is actually loss on acquisition of business, which is not profit, right? Sir, in case of purchase, what would be the adjustment? In case of purchase, the adjustment is just we transfer to the goodwill. But here we are not transferring to the goodwill. You know the reason? Sir, we are just thinking that selling company is not an outsider. In case of external reconstruction, a new company is incorporated to take over existing company. In case of, I already told you, external reconstruction is a classic example for amalgamation in the nature of merger. So that's why selling company is not an outside party. So all the shareholders of the selling company would become the shareholders of the purchasing company. That's why we will treat these losses as revenue losses, not the capital losses. I mean to say, such a loss on acquisition of business takeover should be set off with free reserves. Free reserves exist in reserves and surplus after takeover of selling company business by purchasing company. Now, one more time repeating, the loss on acquisition of the business set off with free reserves exist in reserves and surplus after takeover of selling company business by purchasing company. For example, I'll give some figures here, then you can easily understand. Concentrate. Let us assume the purchase consideration is 50 lakhs. Purchase consideration is 50 lakhs. And share capital, I mean to say face value of share capital. Just a second. This is the face value, which is share capital of selling company. Let us assume 55 lakhs. Let us assume 55 lakhs. Now the situation is, let me take 45, not 55, 45 lakhs. Now, if you observe, the situation is PC is greater than share capital of the selling company. I mean, PC is greater than NAV of the selling company. Am I right? Now, how much loss arised? Loss on business acquisition. How much loss arised here? Loss on business acquisition, which is total 5 lakhs. Now, this loss you need to set off with free reserves. Sir, what is the meaning of free reserves? Those reserves which are freely available for distribution of dividend by the company are technically known as free reserves. You know, in general reserve, balance in profit and loss account is useful for the purpose of distribution of dividend. Now, this is selling company. This is purchasing company. Let us assume selling company general reserve is there. Selling company general reserve is there for 1 lakh. Purchasing company general reserve is there for 2.5 lakhs. In selling company P&L account is there for 3 lakhs. And in purchasing company P&L account is there for 1 lakh. Let us assume like this. Now, what I should need to do? In case of amalgamation in the nature of merger, the reserves and surplus of the selling company belongs to the purchasing company. That means all these reserves, all the reserves of selling company is automatically we are going to incorporate in the books of purchasing company. Now, after amalgamation, how the reserves and surplus will become? We are taking over the reserves and surplus of selling company as well, right? Then 1 lakh plus 2.5 lakh, 3 lakhs plus 1 lakh. Now, all of you please observe here 1 lakh plus 2.5 lakh means which is 3.5 lakh. 3 lakhs plus 1 lakh means here which is 4 lakhs. Now, what you can do? The loss on business acquisition you can knock off with this free reserves and surplus. Now, first you can set off with general reserve. General reserve is there for 3.5 lakhs. Now you can set off with the general reserve. So now if you set off the general reserve, now the balance in general reserve is nil. Still, how much you required? 1.5 lakh. You can reduce such 1.5 lakh from profit and loss account. Then profit and loss account would become how much? 2.5 lakh. Now the net issue is in purchasing company after takeover. in the books of the purchasing company, after takeover of the selling company, the general reserve balance become nil and the profit and loss account balance become 2.5 lakhs. So that is the adjustment need to be done in case of merger. When if PC is greater than NAV, such a loss on acquisition of the business set off with free reserves exist in reserves and surplus after takeover of the selling company business by the purchasing company. Here I am telling you, sir, out of general reserve or P&L, which one can I use first, sir? That is up to you. So it is discretionary. The discretionary power is there with the student itself, because either you can utilize the general reserve or P&L, both are free reserves only. But one thing you need to remember here, guys, if any statutory reserves are there under the reserves and surplus in the books of the selling company, any statutory reserves are there, you should not utilize the statutory reserves for set off the loss on business acquisition, because statutory reserves are not free reserves. Why you need to maintain the statutory reserve? As per a specific act you are maintaining, then how you can trade such reserves are freely available for distribution of dividend. That's why statutory reserves are restricted reserves. You should not utilize statutory reserves to set off such loss on business acquisition. And one more important issue, just I am telling you, please concentrate here, sir. In case of purchase method, I'm not talking about merger method. In case of purchase method, to maintain statutory reserves of selling company in the books of purchasing company, you would like to pass one journal entry, right? That is amalgamation adjustment account data to statutory reserve account. Tell me, guys, we already discussed such issues. Amalgamation adjustment account data to statutory reserve account. After expiry of the time period, you can reverse such entry. For the time being, amalgamation adjustment account, you can show it under negative figure under reserves and surplus. But such a type of adjustment entry, no need in case of merger. In case of amalgamation in the nature of merger, you no need to pass such type of adjustment entry. You know the reason is why? In case of amalgamation in the nature of merger, all the reserves and surplus of the selling company would become the reserves and surplus of the purchasing company. I mean to say, the statutory reserves of the selling company is already incorporated by the purchasing company, and moreover, which are not set off with the loss on business acquisition as well. So that's why still they are carried at their original figures in the books of the purchasing company. No need to maintain such amalgamation adjustment account. There is no amalgamation adjustment account necessary to maintain the statutory reserves of selling company. Do you agree, guys? All of you understand these points? So now, amalgamation in the nature of merger as simple such as amalgamation in the nature of purchase. There is no difference in between purchase method and merger method except these issues. What are such issues? All assets and liabilities, including reserves and surplus, is taken over by the purchasing company. That's why at the time of comparing PC with NAV, we need to compare the purchase consideration with the face value of the share capital of the selling company. If the PC is less than the share capital of the selling company, we will transfer the profit to the capital reserve. If the purchase consideration is greater than the share capital of the selling company, we are treating it as loss on business acquisition. Such a loss on business acquisition, you need to set off with free reserves which are existing in the balance sheet after takeover of selling company by the purchasing company. Am I right? One more thing. To maintain the statutory reserves of the selling company in the books of purchasing company, no need to pass any adjustment entry as like amalgamation adjustment to statutory reserve, because all the reserves and surplus of selling company would automatically becomes the reserves and surplus of the purchasing company after amalgamation. Hope you understand. With this background, let me take one problem first. I will write the journal entries, then your understanding ability will enhance like anything. But if the problem came from amalgamation in the nature of merger, then which is very simple. The reason is there are no difficulties with agreed values here. You can simply make it add a line by line addition of assets and liabilities of selling company with purchasing company, because all are taken over at book values only. All the assets and liabilities are taken over. No need to think about which asset is taken over, which liability is taken over. Is it asset is taken over at book value or agreed value? Such all things will not come into the picture. Okay. So let me take up one problem here. All of you. Before doing such problem, is it problem number 6 done from your side? All of you may know. Is it problem number 6 completed? I gave in yesterday class as an HW. Tell me guys. Tell me guys, all of you. Is it problem number 6 completed? Nobody giving the response here in the chat box. Please, at least some persons can give the response. Okay, hope you completed from your side problem number 6. Sir, problem number 7, we are going to deal along with internal reconstruction chapter, because problem number 7 is a combination problem. Both it includes amalgamation as well as internal reconstruction. So problem number 7, we are not discussing. Okay, next. Sir, problem number 8, we will see later. Okay, all of you please come to problem number 9. Now, this is the problem related to amalgamation in the nature of merger. I'm reading the problem from my side. Concentrate. Consider the following summarized balance sheets of X Limited and Y Limited. Land and building, plant and machinery, furnitures and fittings. Total these 3 are PPEs. Investment account, inventory, trade receivables, cash and bank. That's it. Asset side. Equity share capital, face value 10 rupees. Preference share capital, face value 100 rupees. General reserve is given. Export profit reserve is a statutory reserve. Sir, how to identify a particular reserve as a statutory reserve? For your stage, you are not in a position to identify whether the reserve is a statutory reserve or not. But you can easily identify that such reserves and surplus which you are not aware. I mean to say, you don't know what exactly the meaning of export profit reserve. Okay, then you can just put it as a statutory reserve. Sir, the reserves and surplus which are known to you, I mean to say, sir, if capital reserve is given, which is known to you, if general reserve is given, which is known to you, if profit and loss account is given, which is known to you, that's why all the known reserves are not the statutory reserves. All the unknown reserves are which not aware. Such reserves you can simply put it as statutory reserve. Sir, this is telling for the time being, because at your stage, you are not having good grip on the Companies Act 2013 provisions. But once you enter into the CA final, after seeing the law paper, you can easily understand which reserves you need to be maintained as per the different acts. Because to know if specific reserve is a statutory reserve or not, you should know various laws. How can I expect you are knowing the various laws? Okay, so this is as per FEMA Act, we need to maintain the export profit reserve. Investment allowance reserve. So this is also a statutory reserve. Okay, general reserve is a free reserve. Profit and loss account is also a free reserve. So total 2 free reserves are there, 2 statutory reserves are there. Next, 13% debentures is there. Trade payables exist. Other current liabilities also exist. Now, X Limited takes over Y Limited. X Limited takes over Y Limited. That means X Limited is a purchasing company, Y Limited is a selling company. Okay. On 1st April 2011, X Limited discharges the purchase consideration as below. Issued 3,50,000 equity shares of rupees 10 each at par to the equity shareholders of Y Limited. Issued 15% preference shares of 100 rupees each to discharge the preference shareholders of Y Limited at 10% premium. Can you please tell me, all of you, here method of PC is net payments method or net asset value method or lump sum method or intrinsic value method? All of you, please participate and let me know through the chat box, guys. PC method. What is the method of PC? What is the method of PC? Nobody is responding. Nobody is responding. Yes, now responses are coming. Net payments methods are What about others, guys? Very few members are responding. Very few members are responding. I need more responses. Please, all of you participate in the discussion. Yes, it is absolutely net payments method, because amount payable to equity shareholders and amount payable to preference shareholders, we can easily ascertainable. That's why the method of purchase consideration is net payments method. Now, let us calculate PC. Issued 3,50,000 equity shares at the rate of 10 rupees each means 35 lakhs need to issue to the equity shareholders of the selling company. Issued 15% preference shares of 100 each to discharge the preference shareholders of Y Limited at 10% premium. Now, preference shareholders are discharging at 10% premium means existing face value is 17 lakhs. So 17 lakhs into 110%. 17 lakhs into 110%, which is equal to how much, guys? 18.7 lakhs. So 35 plus 18.7 lakhs, how much? Which is 53 lakh 70,000. Which is 53 lakh 70,000 is the total amount of purchase consideration. Am I right? Guys, just a moment. Mic is disturbing me. Just hold for a second. Yeah, now it's all right. So the thing is, the entire mic wire is there now. So it's completely knocked. Okay, fine. So the purchase consideration is 53 lakh 70,000. Do you agree, guys? All of you, which is net payments method, and the total we are getting 53 lakh 70,000 from point number 1 and point number 2 we decided. Next, come to the below. The debentures of Y Limited will be converted into equivalent number of debentures of X Limited. The statutory reserves of Y Limited are to be maintained for 2 more years. Show the balance sheet of X Limited after amalgamation on the assumption that the amalgamation is in the nature of merger, the amalgamation is in the nature of purchase. I will complete amalgamation in the nature of merger from my end. Amalgamation in the nature of purchase, you should complete from your end. Okay, just here, actually they are asking to present the balance sheet, but we come across this as a first problem in case of merger. So first I will pass the journal entries. After that, I will start doing the balance sheet. Please concentrate, all of you. Problem number 10, right? So problem is problem number 10. Now, all of you, in working note, first let us calculate PC, guys. Calculation of PC. Under which method? Under net payments method. Now, you know, we already seen multiple problems how to calculate PC under net payments method. That is amount payable to equity shareholders. So how many number of equity shares we are going to issue? 3,50,000 equity shares at the rate of 10 rupees each. So total 35 lakhs. Come to preference shareholders. We are discharging the preference shareholders with a premium. I mean, 15% is preference shares issued at the rate of 100 each and discharged with 10% premium. Now the amount is 17 lakhs multiplied with 110%, which is 18 lakh 70,000. So total purchase consideration is 53 lakh 70,000, which is the amount of PC. So if you observe, method of amalgamation will not decide the method of PC. You know that, right? So method of PC is an independent of the amalgamation, independent of the method of amalgamation. I mean to say, whether you are following merger method, whether you are following purchase method. So if net payments is applicable, both is same. Net payments is same in case of both the methods. Net asset value method is same in case of both the methods. Don't be confused. So just I am putting this for your clarity. Okay. Now coming to the journal entries, guys. Next, we are going to pass journal entries. So in which books, guys? In which company books I am passing the journal entries? Purchasing company in Excel Limited books. So what is my assumption? Amalgamation is amalgamation in the nature of merger. Am I right? So right, amalgamation is amalgamation in the nature of merger. Now, what is the first and foremost entry? Can you please tell me, all of you? Business purchase account debtor. That is as usual. Business purchase account debtor to liquidator of Y Limited account, selling company. At the rate of PC we already calculated, which is 53,70,000. 53,70,000. Now you can incorporate all assets and liabilities of selling company in the books of purchasing company. Sir, X Limited take over all assets of the Y Limited, right? So let me put directly sundry assets. I don't want to write individual asset, but if they ask, you need to present clearly in the examination. I'm writing sundry assets account debtor. So what is the total of the sundry assets given here? 66 lakhs, which is 66 lakhs. Okay, to liabilities. So come to the liabilities, guys, one by one. The first and foremost liability is 13% debentures of 13% debentures of Y Limited. You are in the books of X Limited, guys. Don't put 13% debentures. Those are debentures of Y Limited. So to 13% debentures of Y Limited, how much? 3,50,000. All are taken over at book values only. The next liability is trade payable. Two trade payables. Trade payables is also taken over at book value, 3,50,000 only. Other current liabilities, 1,50,000. Am I right? So next, two other current liabilities, 1,50,000. So these are the liabilities. Do you agree, all of you? Sir, apart from the liabilities, in case of merger, purchasing company will also take over reserves and surplus of the selling company. You can incorporate all the reserves one by one. General reserve is there for 2,50,000. To general reserve is there for 2,50,000. Next item, to export profit reserve is there for 2 lakhs. To export profit reserve is there for 2 lakhs. Next, investment allowance reserve is there for 1 lakh. To investment allowance reserve is there for 1 lakh. Next, profit and loss account is there for 5 lakhs. To profit and loss account exist for 5 lakhs. So you should take all the reserves and surplus as well as liabilities and assets into consideration here. Am I right? You are considering the Y Limited books only. Y Limited assets, liabilities, and reserves and surplus. Next, guys. One more thing, X Limited only take over Y Limited. That's why X Limited is a purchasing company, Y Limited is a selling company. That's true only. Come back, all of you. Sir, now what is the NAV of the business takeover? Sundry assets minus liabilities minus reserves and surplus, which is nothing but this part only. NAV of the business takeover is nothing but 47 lakhs. No need to calculate it. Assets minus outside liabilities minus reserves and surplus. No need to calculate it, which is nothing but NAV. NAV of the business takeover is nothing but share capital of the selling company. Share capital of selling company, which is for 47 lakhs. I mean to say, the total debit aspects minus total credit aspects here is equal to 47 lakhs. I need to compare this 47 lakhs with purchase consideration, which is with business purchase account. Am I right? That's why you need to nullify business purchase account to business purchase account. How much? 53 lakh, 70,000. So here, which is there for 53 lakh? 70,000. So the case is PC greater than NAV. If PC is greater than NAV, the difference you need to transfer to loss on business acquisition first. Loss on business acquisition, how much? Which is 6 lakhs, 70,000. So loss having the debit balance, so which is loss on business acquisition. Loss on business acquisition. Concentrate. How much? 6 lakh, 70,000. Now, as per the provisions of accounting standard 14, in case of merger, if you derive loss on acquisition of business, such a loss you can set off with free reserves after business takeover. Am I right? Now, how much free reserves are there? General reserve of the selling company is there for 2,50,000. Already in the balance sheet of the purchasing company, general reserve is there for 5 lakhs. Total general reserve is there with me 5 lakhs plus 2.5 lakhs, which is 7.5 lakhs. Next, profit and loss account 7,50,000 of purchasing company as well as 5 lakhs for me. Am I right? P&L account 7,50,000 plus here how much? 5 lakh. Total 12.5 lakhs. So general reserve is there, total 7.5 lakhs. Profit and loss account is there for 12.5 lakhs. Already general reserve of the purchasing company and profit and loss account of the purchasing company already there in the balance sheet. Again, no need to incorporate. Now, all of you, let me set off the loss on business acquisition by passing the third entry here. Loss on business acquisition account debtor. How much loss? 6 lakhs, 70,000. Sir, 7.5 lakh is more than enough. General reserve itself is more than enough. So I will knock off with general reserve now at the time of set off, loss should be created and reserve should be debited, right? So first, let me write the reserve. General reserve account debtor. How much? 6 lakhs, 70,000 to loss on business acquisition. 6 lakhs, 70,000. Can you please tell me, all of you, still how much balance is there under general reserve after making set off? After making set off, the balance in general reserve is, if you reduce 6.7 lakhs from 7.5 lakh, how much you will get? 7.5 minus 6.7. Still 80,000 balance is there in the general reserve. Profit and loss account balance is how much? 12.5 lakhs. We are not at all using any single rupee to set off the loss on business acquisition. Next, guys. Still the entries are not over. Now you should make payment to whom? Liquidator of Y Limited. Okay. Liquidator of Y Limited account debtor. How much amount, guys? 53 lakh 70,000. What you are paying? Equity shares you are paying. To equity share capital account. How much? In PC you can check that 35 lakhs is the equity share capital, right? So 35 lakhs is the equity share capital. To how much percentage preference shares you are going to issue? 15% preference shares issued at the rate of 100 rupees each only, but discharged with premium, but issue is at a face value only. So 15% preference share capital. Preference share capital, which is 18 lakh 70,000, guys. So can you please make it total 35 plus 18 lakh 70, which is equal to 53 lakh 70,000. Next. Now, one of the liability is, if you observe, 13% debentures of Y Limited. So on behalf of such 13% debentures of Y Limited, equal number of your company debentures are going to issue, right? Now, at that point of time, the journal entry is 13% debentures of Y limited account debtor. How much, guys? 3,50,000. 3,50,000 to your company debentures. Your company debentures are also at 13% debentures only. To 13% debentures account, which is 3,50,000. Sir, in the problem, they asked that statutory reserves of Y limited to be maintained for 2 more years. Sir, can I need to pass the amalgamation adjustment entry? No, because the amalgamation is amalgamation in the nature of merger. You already incorporated both the statutory reserves of the selling company in the books of the purchasing company. In case of purchase method, you are not incorporating the statutory reserves of the selling company into the books of the purchasing company. At that time, you need to pass the entry amalgamation adjustment account data to statutory reserve account. Just I'm clarifying that one as well. That's why. Now, if you see in the nature of merger, the entries are so much simple. Now, let me draw the balance sheet, guys. Concentrate all of you. Now, let us focus on balance sheet. Balance sheet of, what is the company name here? X Limited. After amalgamation. So balance sheet of X Limited after amalgamation. Now you can start the format, guys. Serial number, particulars, note number, amount rupees. So the first and foremost item is equity and liabilities. So under equity and liabilities, we will start with shareholders fund. In shareholders fund, A is share capital. A is share capital. Now all of you please concentrate here. So already X Limited existing share capital is how much? 50 lakhs. So just I'm mentioning in the brackets, but in the examination, you need to provide a separate note number. You know already, to save my time, I don't want to put notes in the brackets only. I will mention, but in the examination, don't put it under brackets, guys. For the time being, I'm put it under brackets. Share capital already existing 50 lakhs. Now, in the form of purchase consideration, we are issuing how much? 53 lakh 70,000. Do you agree? How much we are issuing as 53 lakh 70,000? All are at face value only, right? So that's why you can add that here 53 lakh 70,000. Actually, which contains equity share capital, preference share capital. Equity share capital need to be added. Preference share capital and preference share capital need to be added. But I combinedly just made it for the time being. So the total is 103 lakh 70,000. Am I right? The total is 103 lakh 70,000. But in the note number, how you should need to add, 50 plus 22, this is 72 lakhs total. Both I combined, guys. That is equity plus preference. Both I combined 50 plus 22. I got 72 lakhs. And in case of purchase consideration, which is 53 lakh 70,000. But in note number, you should add equity to equity, preference to preference. And one more thing, here the preference share capital is 14% preference share capital, and the X Limited right now issued the preference shares of 15% preference shares. Am I right? So preference shares are also quite different preference shares we are issuing. In note number, you should need to provide each and everything individually. Now, can you please make it total? Just a second. The total is not correct. What is the total? 72 lakhs plus 53 lakhs 70,000, which I got 125 lakhs reserves and surplus. Reserves and surplus. I'll provide only note number for reserves and surplus, guys. So because which is important here, reserves and surplus. Let me consider the reserves and surplus here. Now, all of you, please let me know one by one reserve. So first general reserve is there, right? So general reserve of X limited, how much? Existing X limited is 5 lakhs. Add Y limited general reserve. How much Y limited general reserve is? 2,50,000. So total is 7,50,000. From here, you are reducing loss on acquisition less loss on acquisition. How much is the loss on acquisition? 6,70,000. So the difference is how much? 80,000. You need to show under the general reserve 80,000. Next, after general reserve, the next item is export profit reserve. Export profit reserve. So which is how much, guys? 3 lakhs plus 2 lakhs for X limited, which is 3 lakhs, and plus Y limited, which is 2 lakhs, total 5 lakhs. After export profit reserve, the next item is investment allowance reserve. Only for Y limited is there. There is no balance in X limited books. 1 lakh, which is. So total, you can directly put it under total. So 1 lakh. So the next item is profit and loss account, P&L account. So for X limited, which is how much? 7,50,000 plus Y limited, which is 5 lakhs. So total is 12,50,000. Now what is the total of reserves and surplus? Can you please make it total here? 80,000 plus 5 lakhs plus 1 lakh plus 12,50,000. So the total of reserves and surplus is 19,30,000. You can put it here 19,30,000 by giving the relevant note number actually. So which is 19,30,000. Okay. So just I'm putting note number 1. Next, share capital over, reserves and surplus over. Am I right? Next, come to non-current liabilities. Non-current liabilities. Under non-current liabilities, A, long-term borrowings. A, long-term borrowings. Now, if you check, 13% debentures of the purchasing company is there with 5 lakhs. Plus, for selling company debentures, we issued our own company debentures. How much worth? 3,50,000. So plus 3,50,000. So total 8,50,000. So remaining all are line by line addition, guys. Simply that is trade payables. I mean to say, sorry. You need to represent it under current liabilities. Under current liabilities, A, trade payable line by line addition 4,50,000 plus 3,50,000, which is 8 lakhs, right? So after that, other current liabilities. Other current liabilities. How much? 2 lakhs plus 1,50,000. So total is 3,50,000. This is the total of liabilities. Coming to assets. So you can write all in your examination. Just I'm writing total of sundry assets because there is no change, guys. Total figures you can just make it add 99 lakhs plus 66 lakhs. There is no change in case of amalgamation in the nature of merger. 99 plus 66 is equal to how much? Which is 165 lakhs. So can you please make it total? Do we getting the correct figure? Let me check the liabilities. 125,70,000 plus 19,30,000 plus 8,50,000 plus 8 lakhs plus 3,50,000. I got exactly 165 lakhs here. So that is 165 lakhs. Here also the total is 165 lakhs. But individual asset you need to present into the examination. Just simply I make it present as a total sundry assets. This is a full-fledged problem based on amalgamation in the nature of merger. What is the new point you learned here? Method of PC in the as usual manner. The new point only thing is at the time of comparison of PC with NAV, any loss occurred, such loss you should need to set off with free reserves after acquisition of the business. And to maintain the statutory reserve, no need to record the amalgamation adjustment entry, because already statutory reserves of the selling company taken over by the purchasing company in process of merger. That's it, guys. Hope you understand. Can I move on with the other problem? All of you, can I move on with the other problem? Please tell me. Quickly respond, all of you. Yes. I'll go to the next problem. Concentrate. This problem is over. Next problem is also related to the merger. Please let me read the problem, but I will not do the problem. You know the reason after reading the problem. Okay. Super Express Limited and Fast Express Limited were in competing the business. They decided to form a new company named Super Fast Express Limited. I mean to say, which is a pure amalgamation. Super Fast Express Limited is a purchasing company. Super Express Limited and Fast Express Limited both are two selling companies. The summarized balance sheet of both the companies were share capital given, reserves and surplus given, trade payables, short-term provisions. Under fixed asset, tangible assets is there, intangible assets are there, inventories, trade receivables, cash and cash equivalents. He is revealing the notes below. So under the shareholders funds, Super Express 20 lakh share capital and Fast Express 10 lakh share capital. Reserves and surplus, insurance reserve, statutory reserve, employee profit sharing account, statutory reserve. If such reserves and surplus is not known to you, which you can simply take it as statutory reserve. Reserve account is nothing but general reserve. Surplus is nothing but profit and loss account. So these two are free reserves. Above two are the statutory reserves. Tangible assets, building and machinery given. Cash and equivalents are given. The assets and liabilities of both the companies were taken over by the new company at their book values. The companies were allotted equity shares of 100 rupees each in lieu of purchase amounting to 30,000 shares. That is 20,000 for Super Fast Express Limited and 10,000 for Fast Express Limited. Decide the type of amalgamation and prepare the opening balance sheet of Super Fast Express Limited. If all the assets are taken over and liabilities are also taken over, and all the assets and liabilities are taken over at book values only, and if you are checking here, the purchase consideration is also just they are making in the form of fully paid up equity shares. That's why we can treat the amalgamation is amalgamation in the nature of. Tell me, guys, amalgamation is amalgamation in the nature of merger. Amalgamation in the nature of merger. Sir, if problem asked like that, then only you can decide the type of amalgamation. But in the examination, most of the times, I mean to say, more than 90%, they will mention the method of amalgamation. They will not confuse you. Sir, which method you need to be adopted, they will give clearly. Or else, if at all not given, at least they are mention the hint. I mean to say, the hint point is, sir, assets and liabilities may not be taken over at book value. Maybe some of the assets are not taken over. Like that, they may give hint. But coming to amalgamation in the nature of merger, they always mention if they want to do a student problem under amalgamation in the nature of merger, they will clearly mention such fact. But if the problem is asked in this way, sir, decide the type of amalgamation from your side, then only you can apply the provisions of AS 14. Then on such basis, you can decide the amalgamation. But in the examination, most of the times they will not confuse at all you. So they will tell the method of amalgamation. Accordingly, you should need to adopt the accounting treatment. So here, this is amalgamation in the nature of merger. One thing is sure. Another thing is, can you please tell me the purchase consideration? Sir, purchasing company, Super Fast Express Limited, two selling companies are there. For one selling company, I am issuing 20,000 equity shares. For another selling company, I am issuing 10,000 equity shares. Sir, 20,000 equity shares means 20,000 into 100, which is 20 lakhs. For another company, 10,000 into 100 means, which is 10 lakhs, which is nothing but PC. Sir, what are the NAV of such selling companies? You know, in case of merger, NAV of the selling company is nothing but share capital of their selling companies. If you observe, share capital of the selling company is 20 lakhs and 10 lakhs only. So 20 lakhs and 10 lakhs means, sir, share capital is 20 lakhs, 10 lakhs, which is nothing but NAV. While compared with PC with NAV, no profit, no loss. No need to recognize loss on acquisition. No need to recognize profit on acquisition, because no profit, no loss. Sir, if it is the situation of no profit, no loss, what should I need to do, sir? Add line by line assets. All the assets simply add line by line. Coming to liabilities, also you can add line by line. Reserves and surplus also you can simply add line by line. Why? Sir, if at all loss on acquisition is there, I may set off loss on acquisition with free reserves and surplus. But here there is no loss on acquisition as well as profit on acquisition. Now you are issuing certain number of equity shares, 30,000 equity shares, right? So 30,000 into 100, which is nothing but 30 lakhs. That is also simple add up on share capital, but the shares are different. You are issuing the new company shares. I mean, Superfast Express shares are issuing. That's why 30 lakhs is the share capital amount. Sir, that means what is the balance sheet totals? The balance sheet totals are 22 lakh 60,000 plus 13 lakhs. And coming to the assets, 22 lakh 60,000 plus 13 lakhs. There is no difference at all. That means if such type of problems asking in the examination, what you should need to do? Simple line by line addition. That's it. Do you understand, guys? So maybe the problem for looking wise, it is very big, but nothing is there. Simple line by line addition of assets and liabilities. In case of merger, if there is no profit, there is no loss situation, then the problem is dead easy. Okay. Next, all of you, please come to the next problem, guys. Which if you observe, which is January 2021 question paper problem I included here. I'm discussing right now one of the question paper problem. Okay. Concentrate, all of you. The problem is important, which is quite easy, but you need to understand the facts of the problem. Shall I proceed, guys? Are you with me? Can I proceed? Yeah, nobody is giving reply in the chat box. Please, all of you participate. Let me check how many members are participating quickly. Can I proceed with problem number 11? Yes, right. Are you with me, guys? All of you? Are you with me? Right, fine. Now come to problem number 11. Galaxy Limited and Glory Limited are two companies. Galaxy Limited and Glory Limited are two companies engaged in the same business of chemicals. So both the business are manufacturers of chemicals. To mitigate competition, you know, one of the objective of amalgamation is to avoid the competition. They may be enter into the amalgamation. We already seen. A new company, Glorious Limited, is to be formed. The new company means which is a purchasing company. The two companies are selling companies, which is a pure amalgamation, is to be formed, to which the assets and liabilities of the existing companies with a certain exception are to be transferred. That means the assets and liabilities of Galaxy and Glory Limited are transferred to Glorious Limited with a certain exception. We don't know what is that exception, but he will reveal such exception at below. But by seeing this sentence, we can easily find that the amalgamation is amalgamation in the nature of purchase. Why? Because certain exception with they are transferred. So if at all any exceptions are there, which is amalgamation in the nature of purchase, he is giving hint that amalgamation is amalgamation in the nature of purchase. The summarized balance sheet of Galaxy and Glory Limited as at 31st March 2020 are as follows. Under shareholders funds, equity share capital 10 rupees each face value is given. Only equity shares are there. General reserve profit and loss account is given. And under non-current liabilities, 6% debentures is there in only one selling company. Trade payables also given. Coming to PPE, freehold property is there. Plant and machinery at costless depreciation is given. Motor vehicles at costless depreciation is also given. Next, coming to current assets, inventory is given. Trade receivables given. Cash at bank is also there. Okay. So this is the information total. Next, assets and liabilities are to be taken at book value with the following exceptions. That means assets, all assets and liabilities are not taken out book value. Some of the assets and liabilities may be taken over at other than book value, he is telling. The debentures of Glory Limited are to be discharged by the issue of 8% debentures of Glorious Limited at a premium of 10%. What it means? The debentures of Glory Limited are to be discharged by the issue of 8% debentures of Glorious Limited at a premium of 10%. One thing you need to understand here, discharge is at face value only, but the newly issued debentures are only happened with premium. I mean to say, if you observe, the 6% debentures worth is at 3,30,000. We are acquiring this 3,30,000 at the rate of book value only. But for such 3,30,000, we are issuing our company debentures, that is Glorious Company debentures, at a premium of 10%. That is the point indirectly he is conveying. So acquired value is nothing but book value only in point number 1. The sentence clearly established that the debentures of Glory Limited are to be discharged. That's it. By the issue of 8% debentures of Glorious Limited at a premium of 10%. The issued debentures are at a premium, but the discharge is happening at the rate of face value only. Next, plant and machinery of Galaxy Limited are to be valued at 2,52,000. Goodwill is to be valued at Galaxy 4,48,000 and Glory 1,68,000. Liquidator of Glory Limited is appointed for collection from the trade debtors and payment to the trade creditors. Here, I mean to say, trade debtors and trade payables of Glory Limited is not taken over by the Glorious Limited. One of the selling company debtors and creditors not taken over by the purchasing company. How would you know such facts, sir? That's very simple. It is clearly given that liquidator of Glory Limited, liquidator of one of the selling company, is appointed for collection from debtors and trade payables means such debtors and trade payables is not taken over by the purchasing company. We are realizing in the outside market. Am I right? He retained the cash balance. That means cash is also not taken over by the purchasing company. From this point, he retained the cash balance up to this. I don't know in future whether the cash is taken or not. Up to this, I can treat that cash is still with the selling company only. He retained the cash balance and collected 1,10,000 from debtors and paid 1,80,000 to the trade creditors. Liquidator is entitled to receive 5% commission for collection and 2.5% for payments. The balance cash will be taken over by the new company. Oh my God. The balance cash is taken over by the new company, he is telling. Sir, all of you, please concentrate here. What is the existing cash balance of Glory Limited here? Where is the Glory Limited? Right hand side part is the Glory Limited. If you check, the cash balance of the Glory Limited is 1,04,000. Now, on the hands of the liquidator, 1,04,000 balance is there first. After that, he will realize cash from the debtors to the extent of 1,10,000. He will pay cash to the trade creditors for the worth of 1,80,000. And liquidator commission is 5% commission on debtors, 2.5% commission on payments. Now, commission on debtors is 1,10,000 into 5%. Am I right? Next, commission on payments 1,80,000 into 2.5%. Then after reduction of this, you will know how much cash balance is available with the liquidator. That cash balance is ultimately taken over by whom? Purchasing company. Can you please calculate, all of you, how much cash balance is transferred from selling company to the purchasing company here? 1,10,000 into 5% means, which is 5,500. Here 1,00,000, this is 1,80,000. This is not 1,08,000. 10. So 1,80,000 into 2.5% means, which is 4,500. Now, can you please tell me, all of you, how much cash balance is transferred by Glory Limited to the Glorious Limited? 1,04,000 plus 1,10,000 minus 1,80,000 minus 5,500 minus 4,500. I got 24,000. 24,000 of the cash balance is transferred by Glory Limited to the Glorious Limited. Now, if you observe, except plant and machinery, goodwill, and this cash balance, and trade debtors and trade receivables, remaining balances all are taken over at book values. You are required to compute the number of shares to be issued to the shareholders of Galaxy and Glory Limited, assuming the face value of each share in the Glorious Limited is 10 rupees. Simply is asking to calculate PC. If you calculate how many number of shares to be issued to the shareholders, which is nothing but purchase consideration only. One thing I am asking you, all of you, after reading the given information, PC is which method you may adopt? Can you please tell me, guys, all of you? Please, all of you participate. PC is which method? Method of PC. Can you able to ascertain amount payable to equity shareholders and preference shareholders directly from the given information? Nobody is participating here. PC is which method? If you are unable to identify method of PC in the examination, then you may not complete the problem. First, let me know what is the method of PC. Still, I am awaiting for your answers. Quickly, guys. Why no one is answering here? Is it net payments method or is it net asset value method? Oh, just let me refresh the query box. Maybe that is the reason. Yes, NAV method. So many are giving the reply net asset value method. Sir, very few members are giving the reply that, sir, which is net payments method. Sir, which is not net payments method, guys. From the given information, you are unable to ascertain amount payable to equity shareholders. Then how you can treat the method of PC is net payments method. So purely the method of PC is net asset value method. First, let me calculate the method of PC. Then you can easily calculate number of equity shares to be issued. And the next question he asked, after completion of amalgamation, you need to present the balance sheet, which is examination problem. Problem number 11. Problem number 11. Sir, after completion of the lecture, I am uploading the PDF copy of my OneNote. Are you observing, guys? Are you downloading? So after completion of every lecture, the updated OneNote part, I am uploading in the PDF download corner. Please, you can download once the lecture got completed. I will upload it. You can download it, guys. Okay. Okay, come here. First, calculation of PC. Calculation of purchase consideration in bracket NAV method. Method of PC is NAV. So particulars, total 2 selling companies are there here. You need to calculate for both the companies. One is Galaxy Limited. Another one is Glory Limited. Am I right? So one is Galaxy Limited, another one is Glory Limited. One by one, if you observe, coming to the assets, all the assets are taken over. One by one assets, freehold property. So freehold property is how much? Only plant and machinery is only taken over at other than book value. Remaining all are at book values only. 5,88,000, 3,36,000. After that, plant and machinery. So plant and machinery, if you check here, plant and machinery of Galaxy Limited are to be valued at 2,52,000. In case of NAV method, the formula is assets taken over at agreed value. So if agreed value is given, you need to consider the agreed value. Then, but for plant and machinery of Glory Limited is considering at book value only. That is at 84,000. So the next item is motor vehicles. So motor vehicles are also at book value only for Galaxy. Nothing is there for Glory. Next item coming to current assets, inventory. So nothing is given here. So inventory you can consider at the book value 3,36,000. And for Glory 4,38,000. Trade receivables, consider all of you. Trade receivables of Glory Limited, he is discussed something. That's why trade receivables are Glory Limited is not taken over by the purchasing company, but trade receivables of Galaxy Limited is taken over 4,62,000. So trade receivables of Glory Limited, liquidator will realize it in the form of cash. Am I right? So that's why don't take the trade receivables. Next, cash at bank. Cash, guys. So the same cash we are taken for Galaxy Limited, which is 2,38,000. Am I right? But for Glory Limited, just now we found that to point number 4, 24,000 cash is taken over by Glorious Limited. That means I can only put the 24,000. If you want, you can provide a separate working note how you got such 24,000. But I already made such working note here. You can consider this as my working note. To save my time, I am putting this as a working note. Okay. Next, less liabilities, guys. Under liabilities, what are the different liabilities you have one by one? So loan, that is 6% debentures. So at the book value only we are acquiring, which is 3,30,000. Next, trade payables. Sir, here we are not taking. For Glory Limited, we are not taking, but for Galaxy Limited, which is 4,20,000. You know why? So trade receivables and trade payables, we are realizing. Liquidator is realizing. Can you please all of you calculate here? What is the amount of NAV in both the companies? Quickly, guys. Let me know first for Galaxy, 5,88 plus 2,52 plus 56,000 plus 3,36,000 plus 4,62,000 plus 2,38,000 minus 4,20,000. Here I got 15,12,000. Now coming to the Glory, 3,36,000, 84,000, 4,38,000. Next plus 24,000 minus 3,30,000. So I got 5,52,000. Is these figures are correct, guys? NAV, net asset value of the business takeover, is it correct? Which you can call it as PC as well. Is it correct? Let me know, guys. Now, in the question, he not asked the PC. What is the question? Actually, compute the number of shares to be issued to the shareholders of Galaxy and Glory Limited. The face value of the Glorious Limited is 10 rupees. Therefore, number of shares to be issued divided by 10. Number of shares to be issued divided by 10 means here 1,51,200 shares. Here 55,200 shares. So one question is over. One question is over. Next question, prepare the balance sheet of Glorious Limited as on 1st April 2020 and also prepare the notes to the accounts as per Schedule 3 of the Companies Act 2013. We need to prepare balance sheet, guys. All of you please concentrate here. So already I done with various balance sheets. So once again, I'm preparing the balance sheet for your convenience. Balance sheet of Glorious Limited. After amalgamation. So before doing this, you need to check one thing. Sir, here PC is equal to NAV. That's why there is no chance of occurring goodwill or capital reserve. This is my observation. No goodwill or no capital reserve. Because PC is equal to NAV. Even though the method is amalgamation in the nature of purchase, here NAV is equal to purchase consideration. That's why no goodwill, no capital reserve. Am I right? And all the equity shares are issued at face value only. That's why there is no securities premium as well. Okay. So with this background, first let me start here equity and liabilities. So I'm directly starting this. Number 1, particulars, note number, amount rupees. Start with equity and liabilities. Under that, shareholders fund. A shareholders, A share capital. Just a second. This is equity and liabilities. Under that, first I need to maintain shareholders fund. So where A is share capital. Sir, Glorious Limited is altogether a new company. That's why there are no assets, no liabilities. Now I am issuing the purchase consideration. Total 15,12,000 plus 5,52,000. Total how much? 15,12,000 plus 5,52,000. Total is I I'm getting 20,64,000. Am I right? So if you make total of the PC, then you will get 20,64,000, which is 15,12,000 plus 5,52,000. I got 20,64,000. Next, coming here, B, reserves and surplus. Sir, we already decided that no capital reserve. And one more thing, at the time of issue of the shares, all the shares are issued at face value only. That's why there is no securities premium. And one more thing, the existing reserves and surplus of both the selling companies is not incorporated by the purchasing company. If it is merger, then reserves and surplus of the selling company is incorporated by the purchasing company. But this is amalgamation in the nature of purchase. That's why reserves and surplus of the selling company is not incorporated by the purchasing company. All such point you should need to bear in your mind. That's why reserves and surplus is nil. Am I right? Is there any other reserves and surplus are there? Nothing. Next, coming to non-current liabilities. Sir, in case of non-current liabilities, which items are there? 6% debentures are there. For such 6% debentures, we are issuing our own company debentures for the worth of 3,30,000. But out of such 3,30,000, how we are going to issue, that is important. Please check here. The debentures of Glory Limited are to be discharged by issue of 8% debentures limited at a premium of 10%. Oh my God, premium is there, guys, here. 3,30,000 divided by 110 rupees. That is how much? How many number of debentures we are going to issue? 3,30,000 divided by 110 means we are issuing 3,000 debentures. Face value is 100. 3,000 into 100 means only worth of debentures is 3 lakhs. Worth of debentures, just a second. Here, debentures worth. So what is the percentage of the debentures we are going to issue? 8% debentures. 8% debentures is only 3 lakh. What about remaining 30,000, sir? Reserves and surplus is not nil. Securities premium is there. 30,000. Tell me, guys, if you cancel the debentures of selling company, what is the entry you need to pass? If at all entry is there, 13% debentures of selling company accounted are 3.3 lakh to 8% debentures 3 lakh to securities premium 30,000. Now securities premium will go to reserves and surplus. 8% debentures will go to non-current liabilities under that long-term borrowings. This is under long-term borrowings. Okay. This is, I'm putting under bracket. Next, after non-current liabilities, what is the other liability you are having? Trade payables you are having. Am I right? Trade payable only there for Galaxy Limited. You can consider under current liabilities. Number 3, current liabilities. A, trade payable. So total how much, guys, here? Trade payable total 4,20,000, which is 4,20,000. You can make it total. This is the total of liabilities. Now you can come to assets, guys. Under assets, number 1, non-current assets. You can simply see the net asset value method. All are exist. Sir, first under non-current assets, PPE, if you can consider, the PPE value is total of this. The PPE value is total of this. You can make it total 5,88,000 plus 2,52,000 plus 56,000 plus 3,36,000 plus 84,000. Total 13,16,000. Total is 13,16,000. So PPE, I'm writing A PPE. So A PPE is 13,16,000. Next, guys, after PPE, what is the next item? Here itself you can find inventory, trade receivable, cash. You can directly put it as current assets. Number 2, current assets. A, inventory. B, what he is given? Trade receivables and cash equivalents. Trade receivables, cash and cash equivalents. You can add one by one, guys. Inventory total is how much? 3,36 plus 4,38. I got 7,74,000. 7,74,000 Trade receivables total is how much? You can make it total the trade receivable 4,62,000, which is 4,62,000. What about cash and cash equivalents, guys? Coming to cash and cash equivalents. Sorry. Yeah. 2,38,000 plus 24. 2,38,000 plus 24,000. 2,62,000. 2,62,000. Like this, you need to write one by one, guys. Now, there is no goodwill also erased. You can make it total of assets 13,16,000 plus 7,74,000 plus 4,62,000 plus 2,62,000. Total 28,14,000 here. Am I right? 28,14,000. You can make it total of the liabilities 20,64,000 plus 30,000 plus 3 lakhs plus 4,20,000, which I got 28,14,000, which is tallied. You can cross check. How much time took for me, guys, to complete the problem? How much time took for me? So hardly within 10 minutes, I completed the entire problem. So PC, I calculated number of equity shares, which is the question number 1A answer. Under that first question answer. So this is second one, balance sheet. So the problem is asked for 15 marks. Hardly I took 10 minutes to complete the entire problem. So once if you have good grip on the concept, it doesn't take much time to complete the problem. Hope you understand. Am I right, guys? Which is not a new problem, in general problem only. Can I proceed further? Oh, in question, goodwill is given for both the companies. Why we didn't took? Sorry, yaar, I forgot. Really, I forgot. Then what you should need to do? You should need to do one thing. Yes, you are correct, my dear. Goodwill is not considered by me. Even though how the problem is tallied, that is the surprising fact, So that's very simple. If you add goodwill, PC is more. Then goodwill is added, share capital is also added. It's very simple. You can consider the goodwill. That's correct. I was not considered the goodwill. You're absolutely correct. So please consider the goodwill as well. 4,48,000 and 1,68,000. 4,48,000, 1,68,000. Now there is change in PC. Just add 4,48,000, 15,12,000 plus 4,48,000. It becomes 19,60,000. It becomes 19,60,000 after adding the goodwill. Here 5,52,000 plus 1,68,000. It becomes 7,20,000. It becomes 7,20,000. Now there is a number of change in shares, guys. So problem we done correctly only, just we are not considered the goodwill. No worries. So here 19,60,000 divided by 10 rupees. How much? 1,96,000 shares. Here 72,000 shares. Now what is the total amount of share capital? 19,60,000 plus 7,20,000, which becomes 26,80,000. Which becomes 26,80,000. Now liabilities increase in na. Assets also you should need to increase na. That is B, intangible assets. B, intangible assets. Sir, if you add goodwill in both the companies, that is 4,48,000 plus 1,68,000. Total is 6,16,000. So here also you can add 6,16,000. What is the impact? For assets you added 6,16,000. Liabilities also you added 6,16,000. Okay. Now what is the total? 34,30,000. Am I right? Which is 34,30,000. I think so. Here also 34,30,000. That's it, guys. Now I completed the problem without adding the goodwill. Now I added the goodwill. Okay. Tell me, guys, is it okay? Fine to all? Now I considered everything. Hopefully. Nobody is providing the answer, guys. Let me know. Is it fine? Everything is correct? Can I proceed? Someone is telling that, sir, inventory is 7 lakh 84. How it is 7 lakh 84? The inventory is? No, the inventory, if you check, 3 lakh 36,000 plus 4 lakh 38,000, which is 7 lakh 74 only. I made it correctly, guys. Please, all of you concentrate. It is 34 lakh 30,000. I will cross check with solution as well. Why not? Let me check the final figures. Problem number 11. 11. Come here. 34 lakh 30,000 is the final answer in the my printed solution. So now in my OneNote, I get how much? 34 lakh 30,000, which is absolutely fine. Okay. Hope you all are following, guys. Someone is asked, sir, yesterday MCQ assessment was also there in MCQ assessment. Okay, fine, sir. Yes, now done. Add goodwill. Yes, fine. One of our student asked a doubt, sir, in problem number 9, why preference shares are used for PC, as in merger only equity shares are used? Sir, please explain the reason for debiting loss on acquisition in place of goodwill. My dear, I already told the reason. You are not listening. Sir, in case of amalgamation in the nature of purchase, at the time of loss of acquisition, we are treating it as a goodwill. The reason is we are treating it as a capital loss. So that's why the PC we are paid over and above the NAV, we are treating it as goodwill. You know such fact already. But coming to amalgamation in the nature of merger, the other company, I mean selling company, is not an outsider, because all the shareholders of the selling company becomes the shareholders of the purchasing company. So just remember the concept of external reconstruction. A new company is incorporated to take over the existing company. I mean to say all the shareholders of the existing selling company would become the shareholders of the purchasing company after amalgamation. 90% of the share capital, that is, shareholders holding 90% of the share capital, should become the shareholders of the purchasing company after amalgamation. That is one of the condition, right? I mean to say, more or less, there is no difference between shareholders of the selling company and shareholders of the purchasing company. That's why you are treating it as a capital loss. Just you can treat it as a general loss. General loss means if any profit or loss occurred in your business, to which account you are internally transferring? Profit and loss account, which is nothing but free reserves. Like that, now the profit, if you get in, you can treat it as a capital reserve. The reason is, if you can add it to the profit and loss account, then you may be used for such profit for the purpose of distribution of the dividend. But the profit derived due to acquisition of business, you should not be utilized for the purpose of distribution of the dividend. That's why at the time of getting the profit, I told that you can make it transfer to capital reserve. But at the time of occurring of the losses, you can reduce the existing profit and loss account at the general reserve. That's why you should not make it transfer to the goodwill. You should be knock off with the profit and loss account exist at the general reserve. That is the point I told you. That is the reason, guys. So in case of pooling of interest method, we can treat selling companies as just an extension to the purchasing company. We are just as treated as normal loss only. That is the reason why we are not transferring to goodwill, why we are making set off with free reserves after taking off the business by the purchasing company from selling company. Hope you got it. Okay, next. Sir, will you post this question and answer? Yeah, surely, ma. After this, I'll post some more question and answers. Not an issue. Okay, let it be. At this stage, we can do one thing. So time is approximately 8:25. All of you, please, you can take break for 10 minutes. Please, all of you can assemble at 8:35 exactly. So the second half is going to start at 8:35. We will see some more examination problems. So just I want to dedicate more time for the purpose of seeing examination problems. So after the break, we will see 2 more examination problems, guys. So please, all of you take break from your side. Yes. So welcome back, guys. We completed up to problem number. Just a second. So the last problem is problem number 11, right? So just now we seen January 2021 examination problem. Now, sir, another examination problem. Now we are going to see through problem number 2, which is related to July 2021. I think so, right? Yeah, July 2021 examination question paper. Concentrate, guys. All of you. The problem is a little bit different, but it is not related to pure amalgamation, which is a combination of amalgamation and that is how to prepare the financials at another date. So after seeing the problem, you can understand things. So first, let us have a look. The summarized balance sheet of Black Limited and White Limited as on 31st March 2020 is as follows. All of you observe the balance sheet is given at 31st March 2020. So share capital is there, reserves and surplus is given. Next, under non-current assets, property, plant and equipment is given. Inventories, trade receivables, cash and cash equivalents. Share capital, equity shares of rupees 100 each. Reserves and surplus, general reserve is there. Profit and loss account is also given. Black Limited takes over White Limited on 1st July 2020. Black Limited takes over. That means Black Limited is a purchasing company. White Limited is a selling company. So purchasing company takes over the selling company as on 1st July 2020. No balance sheet. So one thing is sure, the existing information is given as on 31st March 2020, but the amalgamation is going to occur as on 1st July 2020. That means after 6 months, amalgamation is going to happen. Till now, what are the problems we done? Till now, what are all the different problems we completed? In all the problems, date of balance sheet and date of amalgamation is same. That's why there is no necessity to prepare the balance sheet before amalgamation first. But here the question is, there is no balance sheet exist. No balance sheet of White Limited is available on that date. So selling company balance sheet is not available as on the acquisition date. That means the question you need to reframe from your side. You need to prepare the balance sheet as on 1st July 2020. Then you can start doing procedure of the amalgamation. That is the specialty of the problem. Nothing else, unless otherwise all are remaining normal issues only. It is, however, estimated that White Limited earned a profit of 2,40,000 after charging proportionate depreciation at the rate of 10% per annum on property, plant and equipment. Sorry, after 3 months, not 6 months here. After 3 months, right? Yeah, per annum on property, plant and equipment during April to June 2020. He is clearly given that in these 3 months, the profit is 2,40,000. This profit is after charging proportionate depreciation on the plant and machinery. Am I right? So can you please tell me on property, plant and equipment, what is the amount of proportionate depreciation, guys? If you observe here, property, plant and equipment of White Limited, here it is there 2,400. All the rupees are in thousands. I will also take the same figures. Okay, 2,400 into 10% into 3 by 12. How much? 240 into 3 by 12, which is 60. I mean 60,000 is the depreciation. After providing the depreciation, profit is 2,40,000. That is before providing the depreciation, profit is 3 lakhs. That is the information he is giving. Next, what is the next information? Estimated profit of Black Limited during these 3 months. Earlier he was talked about White Limited. Now he is telling about Black Limited. Okay. Estimated profit of Black Limited during these 3 months was 4,80,000 after charging proportionate depreciation of 10% per annum on plant and machinery. Here, what is the amount of depreciation? Let us have a look. 3,600 is the book value, right? So 3,600 into 10% into 3 by 12. How much? 360 into 3 by 12, guys, which is 90,000. That is 90. That is, yeah, concentrate. That is After charging depreciation 4,80,000, then before charging depreciation profit would be 4,80,000 plus 90,000, which may be 5,70,000. Just for informative, I'm telling. Both the companies have declared and paid 10% dividend within such 3 months period. At the time of declaration of the dividend, what is the journal entry? Reserves and surplus accounted are to dividend payable account, dividend payable accounted are to bank account. Simply, the impact is you need to reduce the reserves and surplus as well as you need to reduce the bank balance. Reserves and surplus to dividend payable to bank means dividend payable cancel to each other. Then reserves and surplus to bank account is the net journal entry. Am I right? Do you agree? Now, what is the amount of dividend? Can you please tell me, all of you here? Both the companies have declared the 10% dividend is given, right? Now, let us check dividend amount here. Share capital, under that share capital, equity shares are there for 6,000 here, 3,600 is there here. Sir, into 10% means which is equal to 600 here, into 10% which is equal to 360 here. So what happened? This 600 is reduced from reserves and surplus. This 360 is also reduced from reserves and surplus. Now the net reserves and surplus would become 1080 minus 600. Am I right? Next, this is also the reserves and surplus minus 360. At the same time, you need to reduce from the bank balance as well. Where is the bank balance? Cash and cash equivalents. Here it is there. You need to reduce the dividend amount also from cash and cash equivalents from both the companies. Okay. What next? Goodwill of White Limited is valued at 2,40,000 and property, plant and equipment are valued at 1,20,000 above the depreciated book value on the date of takeover. So these are the agreed values actually. So if you observe here, there is no goodwill in the assets. So directly he is only given the PP. There is no intangible item in the existing balance sheet, but he is agreed for the purpose of goodwill 2,40,000 and property, plant and equipment is valued at 1,20,000 above the depreciated book value on the date of takeover. Now, if you observe, coming to the White Limited, sir, White Limited depreciation on the PPE is 60,000. Now, what is the net book value after providing the depreciation? Property, plant and equipment is 2,400 minus 60. How much it will be? 2,340. 2,340. Now, on this 2,340, I mean to say, on this 23,40,000, he is adding 1,20,000 excess. 1,20,000 excess is adding 120. So total how much? 2,340 plus 120 is equal to 2,460 is the agreed value. So till now, I don't know the requirement. Just I'm reading the problem. I'm explaining the facts of the problem. That's it. Okay. Next. Purchase consideration is to be satisfied by Black Limited by issuing shares at par. Ignore income tax. You are required to compute number of shares to be issued by Black Limited to the White Limited against purchase consideration. First question I am asking you. Method of PC. Can you please participate, all of you? What is the method of PC? Quickly, guys. I need replies from you. Quickly, all of you. Let me know. What is the method of PC here? Quickly, guys. Can you please tell me, all of you, what is the method of PC? Net asset value method, guys. Net asset value method. Simply NAV method. Do you know the reason? Sir, anyway, how many number of equity shares to be issued? Do you know? After reading the given information, do you know in any point it is clearly given that how many number of equity shares to be issued by Black Limited to White Limited? Nowhere it is mentioned. The method of PC is net asset value method. On such a net asset value method, if you divided with issue price, it is clearly given that Black Limited is issuing at par, NAV divided by face value per share, then you will get number of equity shares to be issued as PC or number of shares issued as PC you will get. Okay, NAV method. Sir, some of our students asked one doubt. Sir, why you are considering the dividend for the entire year? They are only given the problem for April to June is related to only 3 months. Why you are considering dividend for entire year? My dear friend, you need to understand one thing here. Both the companies have declared and paid 10% dividend within this 3 months period. He is not telling that dividend is related to 3 months period. Always the dividend will be declared for a particular year. Actually, so after completion of the year, the dividend in generally paid for the previous year. Let us assume right now in the year 2021, we are in the year 2021, 2020-21. What is the previous year? 1920. For the year 1920, we will declare the dividend in the year 2021. Like that, in the year 2021, within such 3 months period, company declared the dividend for the year 1920. So 1920 dividend is for the entire 12 months. Always dividend you need to calculate on face value of the share capital. Dividend will not depending upon the time period. Sir, 6 months dividend, 3 months dividend, 5 months dividend, it will not work out like that. Dividend in generally paid for a particular period. Hope you got my point, guys. Okay, fine. Come below. Now let me continue. Method of PC is net asset value method. So after getting the net asset value, if you divide with the face value, then you will get number of equity shares to be issued as a PC. The same question asked under question number 1, which is related to amalgamation problem. Next, coming to question number 2, calculate the balance of net current assets of Black Limited and White Limited as on 1st July 2020. Second question is not related to amalgamation. General question. Sir, they are giving the balance sheet information as on 31st March 2020. They are asked to know the balance of net current assets of Black and White Limited as on 1st July 2020. Is it related to amalgamation issue? No. Sir, at certain point of time, if they provide the information, from that you need to derive the information as on 1st July 2020. That is the general case, not related to amalgamation. Give balance of profit and loss of Black Limited as on 1st July 2020. As on 1st July 2020, you need to give the profit and loss account of Black Limited. This is also not related to amalgamation issue. Give balance of property, plant and equipment as on 1st July 2020 after takeover. Out of the 4 questions, 3 questions are general issues. 1 question is only related to amalgamation issue. Do you agree, all of you? Now, let us concentrate on the net asset value. So just I want to explain this problem along with my printed solution. I don't want to take that much of pain in my OneNote for the purpose of calculations. I will explain each and everything in a beautiful manner, but to avoid my calculations, just I want to explain the entire thing with my solution. Please all of you concentrate here. Roll number 12. So first, number of shares issued by Black Limited to White Limited against the purchase consideration. First, I am calculating the purchase consideration under NAV method. Now, one by one, let me take over. So this, when I need to calculate, as on 1st July 2020, I need to calculate. That means I required all the balance of assets as well as all the balance of liabilities as on 1/7/2020. But if you observe here, certain assets I am taken over at agreed value, like goodwill is taken over at agreed value. Property, plant and equipment is also taken over at agreed value. Except these assets, remaining assets and remaining liabilities are taken over at book values as on 1st July 2020. So now I will start the problem with this goodwill. Now goodwill account at R. That is, goodwill is 2,40,000. Am I right? One of the assets. Next, property, plant and equipment, at which value they are taken over, I already decided, which is at 2,460. So if you check, 24,60,000 is the property, plant and equipment. Rupees in thousands, which is 24,60,000 is the property, plant and equipment. Am I right? 2 assets are over. Next, remaining all assets are at book value. Inventory, 7,20,000. Trade receivables, 10,80,000. Cash and cash equivalents, I need to calculate. Just wait. So if you check inventory, 7,20,000. Trade receivables, 10,80,000. Now let me calculate cash balance as on 1st July 2020. All of you please concentrate here. Opening cash balance how much? 4,20,000. Now, what are the cash transactions occurred, which is the opening balance case, which is the opening balance. What are the cash transactions occurred in between 31st March 2022, 1st July 2020? One thing, you derived the profit. You derived the profit. Am I right? Cash profit you need to add, not the original profit. You need to add cash profit. Why? Because if you observe here, in White Limited, before charging depreciation, profit is 2,40,000. Depreciation is a non-cash expenditure. If you want to know the cash profit, for this profit, you should need to add back the depreciation. Depreciation is 60,000, 2,40,000 plus 60,000, then you will get 3 lakhs. 3 lakhs is the cash profit. So cash profit is 3 lakhs. You should need to add. But one more transaction occurred. You declared the dividend, right? You declared the dividend in both the companies. In White Limited, if you declared the dividend, which is equal to 3,60,000, you can reduce the dividend of 3,60,000. Apart from that, there is no other cash transaction occurred. If you can observe, profit is there. That is one thing. One more thing, you have declared and paid the dividend. That is another cash transaction. Apart from this, there is no other cash transaction. That's why, may I know the closing cash balance? 4,20,000 plus 3 lakhs is 7,20,000. 7,20,000 minus 3,60,000, which is 3,60,000. So the cash balance is 3,60,000. Cash and bank balance, which is 3,60,000. So it is not under brackets. This is which is an asset. Sorry, print mistake in the printed solution. Don't put under brackets, which is the positive balance now. Now the total assets, if you can add 2,40,000, 24,60,000, 7,20,000, 10,80,000 plus 3,60,000, then total of assets we get 48,60,000, which are total assets. Do we agree, guys? Now I need to reduce the liabilities. Liabilities at book value only I need to reduce. Liabilities, if you observe, trade payables is there for 3,60,000. That's why we reduced to 3,60,000. Then NAV we got 45 lakhs. NAV of the business is 45 lakhs, which is equal to PC as well. Then how many number of shares to be issued? 45 lakhs divided by face value 10 rupees per share. Then you need to issue number of shares. Sorry, face value is not 10, guys. Here face value is 100, because if you observe here, the share capital is given at 36 lakhs. Under the notes to accounts, it is clearly given that the face value is 100 rupees in both the companies. That's why Black Limited is going to issue at the rate of 100 rupees. Then the number of shares would become 45,000 shares. Such a simple issue. Do we agree, all of you, this one? Next, coming to the next question. So question number 1 related to the amalgamation over. The next question is calculated the balance of net current assets of Black Limited and White Limited as on 1st July 2020. All of you, please come to net current assets. Sir, what is the meaning of net current assets? Net current assets is nothing but current assets minus current liabilities. That means I need to work out current assets and current liabilities as on 1st July 2020. First, all of you come to current assets here in the balance sheet. 3 current assets are there. One is inventory, another one is trade receivable, another one is cash and cash equivalent. Am I right? Sir, in both the books, inventory is same. In both the books, trade receivables also same. As on 1st July 2020, I'm talking. Now, related to cash and cash equivalents, related to White Limited, you already know the cash and cash equivalent, which is 3,60,000. Am I right? It is not 4,20,000, it is 3,60,000. So then what about cash and cash equivalent in case of Black? This is White Limited. Let us work out the Black Limited cash and cash equivalents. All of you. Opening balance is how much? 14,40,000. Now you can add the cash profit here. In case of Black Limited, cash profit is how much? Black Limited normal profit is 4,80,000. Depreciation is 90,000. If you add back, then he will get 5,70,000 is the cash profit. You can add 5,70,000 cash profit. Minus, you can reduce the dividend. Dividend is how much in case of Black Limited? 6,000 into 10%, which is 600, means amount is 6 lakhs. You can reduce the 6 lakh amount here. Then may I know the cash balance in Black Limited as on 1st July 2020? 14,40,000 plus 5,70,000 minus 6 lakhs, which equal to 14,10,000. Now I got entire information of current assets is ready. Am I right? If I go to current liabilities, I will take over the current trade payables at the book values only. Now let me open my solution. Let us go to the net current assets value. First, let me check the black limited. Inventory at as it is value. If you check the inventory, 9,60,000. Next, trade receivables, if you check the as it is value, 16,80,000. Cash and bank, just now we calculated, we get 14,10,000. He also get 14,10,000. Trade payable 6 lakhs is the book value. In case of White Limited also, we work out all the same values. The only difference is cash. Cash we already earlier calculated, which is 3,60,000. Then we got net current assets. Do you agree, all of you? Tell me, guys, are you with me? So net current assets valuation is also over. Next, come to the below, guys. What is the next question? Give balance of profit and loss account of Black Limited as on 1st July 2020. It's very easy. So now, if you check, opening profit and loss account is how much? Opening profit and loss account, 7,20,000. In Black Limited, I'm talking. Opening profit and loss account is 7,20,000. Just a second. Opening is 7,20,000. Out of this, you declared the dividend. Or first, opening is 7,20,000. Just a moment. Opening is 7,20,000. Current year, you earned a profit. How much profit you earned in case of Black Limited? So coming to the Black Limited, here it is there. The profit is 4,80,000 you earned. You can add the profit of 4,80,000. Then this is the P&L account accumulation balance as on 1st July 2020 before declaring the dividend. Now, if you declare the dividend, how much dividend declared in case of Black Limited? 6 lakhs. If you declare the dividend, then P&L account balance is decreased. Then what is the balance of P&L as on 1st July 2020? 7,20,000 plus 4,80,000 minus 6 lakhs. How much you got? 6 lakhs is the difference. That is the profit and loss account balance as on 1st July 2020 is 6 lakhs. You can cross verify with the solution. How much you got? 6 lakhs. Then come to the final question. Give balance of property, plant and equipment as on 1st July 2020 after takeover. He's asking after takeover value. Now, all of you come here. What is the property, plant and equipment in case of Black Limited, guys? In case of Black Limited, which is 3,600. 3,600 means rupees are in thousands, right? That how much amount it is? 36 lakhs. This is the opening value. But depreciation is there, na? Depreciation how much, guys? In case of Black Limited, depreciation is 90,000. You can reduce the depreciation of 90,000 first. The net book value in Black Limited how much? 35,10,000. For this, you have to add the agreed value of the plant and machinery. You know already the agreed value of the plant and machinery under NAV method. What is the agreed value of the plant and machinery? We work out, which is 24,60,000 is the agreed value of the plant and machinery. If you can add 24,60,000, then you will know plant and machinery balance in Black Limited after takeover. 35,10,000 plus 24,60,000. I got 59,70,000. You can cross check with the printed solution answer. The final question is 59,70,000. That's it, guys. Such a simple question, but out of the 4 questions, 1 question is only related to amalgamation. Remaining 3 questions are related to deriving the balance sheet items based on the given information as on a specific date. Deriving balance sheet components at a future date from the past date. From the past date information, just you are deriving the balance sheet components. That's it, guys. Okay. Sir, one more thing. Like this type of problems may also tested in partnership accounts. So I don't know. Still partnership accounts are not yet over. Or is not a take up. I don't know. In partnership accounts also, what they will ask, the problem will start in the past. It will continue. They are continued a business for certain point of time. After that, what happened? One partner may be retired, or one partner may be death will happen, or after that, the business will be taken over by a company. So just I'm telling you here, this is not relevant for my subject. To my chapter, but still, just I want to discuss. In case of partnership accounts also, what happened? Okay, so the partnership business start here. That is, which is the initial point of time. It will start here. It will continue for certain time period. So like 6 months, like that, it will continue. After that, at the end of the 6 months, what will happen? Reconstitution will happen. Reconstitution means maybe change in PSR, or maybe retirement of the partner, or maybe death of the partner, or maybe that is additional partner appointment of the partner. Anything may happen. So these are reconstitution is going to happen. After this reconstitution, now the partnership firm is taken over by another company, or partnership firm is amalgamated with another company. Like this, they may test the problems in the examination. But one thing is sure, amalgamation is related to group 2 only, and partnership accounts is also related to group 2. There is a high scope to test such questions in the examination. So you can come across such type of problems in partnership accounts. So let me leave such thing. Okay, come back here with this problem number 12 is over, guys. Now, all of you, let me concentrate problem number 13, which is the last problem for the chapter amalgamation. So at the end of the session, I will clarify what are the doubts you have. So just I want to dedicate approximately 10 minutes for the purpose of your doubts. So let me take the problem number 13. Once problem number 13 discussion is over, then I will clarify all your doubts. You can send the queries, whatever you have, through the query box. Okay, come to problem number 13. High limited and low limited were amalgamated on and from 1st April 2020. The date of amalgamation is 1st April 2020. A new company called Little Limited was formed to take over the business of the existing companies. These two companies are selling companies. Little Limited is a purchasing company. One thing is sure, this is also examination problem, if I'm not wrong. Yes, which is November 2020 examination problem. Okay, next. So let me continue. A new company, Little Limited, was formed to take over the business of the existing companies. The summarized balance sheet of both the selling companies on 31st March 2020 were as under PPE. Under PPE, 2 PPEs are there. Land and building, plant and machinery. Under investments is given. Investment is separately given. Under current assets, stock is there. Sundry debtors is there. Bills receivable is there. Cash and bank. Under share capital, equity share face value 100. 14% preference share is 100 rupees face value. Under reserves and surplus, revaluation reserve, general reserve, investment allowance reserve, profit and loss account is also given. I think so, which is statutory reserve, investment allowance reserve is statutory reserve. Under non-current liabilities, secured loans, 13% debentures is given. Unsecured loans, public deposits is given. Current liabilities and provisions, sundry creditors, bills, payables are given. So this is the full-fledged balance sheet. Other information, 13% debenture holders of High Limited and Low Limited are discharged by Little Limited by issuing such a number of its 15% debentures of 100 each, so as to maintain the same amount of interest. This is the catchy point. So as to maintain the same amount of interest. What they required? Sir, before the amalgamation or after the amalgamation, the existing debentures of High Limited and Low Limited want to get the same amount of interest. Now first let me check what is the existing amount of interest here. So in the entire problem, rupees are in lakhs. So rupees are in lakhs means here 100 lakhs and 56 lakhs. Now concentrate. Here 100 lakhs worth of debentures are there. Here 56 lakhs worth of debentures are there. What is the existing amount of interest? 100 lakhs into 13%. 13 lakh is the interest here. 56 lakhs into 13%. 7.28 lakh is the interest here. Am I right? Now what they want? Sir, after amalgamation also I require the same amount of interest. But after amalgamation, that new debentures are 15% debentures. That means the 15% debentures, the interest into, I don't know how much worth of face value to be issued. This face value, you need to calculate, it should be equal to 13 lakhs. The face value is equal to, the face value of the worth of debentures to be issued is equal to 13 lakhs divided by 15%. 13 lakhs divided by 15% means I need to issue 86.67 lakhs worth of debentures. Am I right, guys? All of you with me? So 13 lakhs divided by 15% is how much? 13 lakhs divided by 15%. Here it is. How much it is? 7,28,000 divided by 15% here. This is the worth of debentures I need to issue. This is the worth of debentures I need to issue to whom? Both the debenture holders of I Limited or Low Limited. Or I can treat this is the acquired price of the debentures. This is the agreed value of the debentures. Do you agree, all of you? This is point number 1. Next, coming to point number 2. But one thing is sure, amount payable to the debenture holders of the selling company is not form part of PC. No worries. Preference shareholders of the two companies are issued equivalent number of 15% preference shares of Little Limited at a price of 125 rupees per share. Face value is 100. Sir, I am issuing the same number of preference shares means here I am issuing 3.2 lakh. How many number of preference shares are there here? 320 divided by 100 means 320 divided by 100 means 3.2 lakh shares are there here. Here 1.75 lakh shares are here. Now I'm going to issue the same number of preference shares only. It is clearly given that preference shareholders of two companies are issued equivalent number of 15% preference shares of the Little Limited at a price of 125 per share, but the face value is 100. Number is same, but the worth is different. But the worth is 125 rupees. Now amount payable to preference shareholders is 3.2 lakh into 125, 1.75 lakh into 125. Like this, you need to calculate, which is form part of PC, guys, which is form part of PC. Next, coming to point number 3, Little Limited will issue 4 equity shares for each equity share of High Limited and 3 equity share for each equity share of Low Limited. The shares are to be issued at 35 rupees each, having a face value of 10 rupees per share, which is also form part of PC. With the given information, if you can able to ascertain amount payable to equity shareholders and preference shareholders, then the method of PC is, tell me guys, net payments method. We can able to ascertain from the given information how much amount is payable to the shareholders of the selling company. That's why method of PC is net payments method. Now come to the below. Investment allowance reserve is to be maintained for 2 more years. Okay. Sir, the amalgamation is amalgamation in the nature of purchase. How you know such facts, sir? It is clearly given through point number 1. We are not acquiring the debentures at face value. We are acquiring the debentures at agreed value. Sir, if any one of the asset or liability is acquired at other than book value, then the method of amalgamation is amalgamation in the nature of purchase. In case of amalgamation in the nature of purchase, reserves and surplus of the selling company would not become the reserves and surplus of the purchasing company. That's why to maintain the investment allowance reserve, I need to pass adjustment entry amalgamation adjustment account to statutory reserve account. So one of the statutory reserve is investment allowance reserve. Now investment allowance reserve 80 plus 40, total 120 lakhs I need to be maintained in the books of purchasing company. Prepare the balance sheet of Little Limited as on 1st April 2020 after the amalgamation has been carried out on the basis in the nature of purchase. I need to adopt balance sheet. But before adopting the balance sheet, first can you please all of you calculate the purchase consideration under net payments method? Purchase consideration under net payments method. I mean to say to equity shareholders how much we need to pay, guys? Here 2 companies are there. What are such company names? High, low. So the company names are high, low. So to equity shareholders, it is clearly given that 4 equity share for 1 equity share of High Limited. How many number of equity shares are there? Here 10 lakh, right? Sir, for 1 equity share, we are issuing 4 equity shares means for 10 lakh equity shares, we are issuing 40 lakh equity shares. So the number of equity shares are here 40 lakh, and each equity share is issued at 35 rupees. Therefore, the worth is 40 lakhs into 35 rupees, which is equal to 1400 lakhs. Next, coming to the low limited, it is clearly given that 3 equity share for each equity share of low limited. How many number of equity shares are there in low limited? If you observe here, 8,50,000 equity shares are there. Now, for 8.5 lakh equity shares, we are issuing 3 equity shares into 35 rupees. How this is coming as 40 lakh? This one also you can write like this, 10 lakh into 4. Okay. Now, the worth is how much? 8.5 lakh into 3 into 35. You got 892.5 lakhs. This is amount payable to equity shareholders. In the same way, you can calculate amount payable to preference shareholders. If you observe in point number 2, preference shareholders of the two companies are issued equivalent number of 15% preference shares of Little Limited at a price of 125 per share. That means number of preference shares into 125. Here, 3.2 lakh, right? So, 1 second, guys. I multiplied correctly only for equity shares, right? Tell me. Yeah, I considered correctly, not an issue. Yes. So now coming to preference shares, which are 3.2 lakh, 3.2 lakh into 125 rupees. Here, how much is given? How many number of equity shares? How many number of preference shares are given? 1.75 lakh. 1.75 lakh into 125. Now, can you please tell me amount payable to the preference shareholders how much? 3.2 into 125, which is equal to 400 lakhs here. Here 1.75 into 125, which is equal to 218.75 lakhs. Now, what is the total amount of PC? Here 1800 lakhs. Here 892.5 plus 218.75. Here it is 111.25 lakhs. This is the amount of purchase consideration. Sir, why you need to calculate this? This is PC, right? This is purchase consideration. To draft the balance sheet, first you should know profit or loss derived through acquisition of the business. I mean, do you arrive the goodwill or capital reserve? So it should be compared with net asset value of the business takeover. Now, NAV, except debentures, remaining all are taken over at book values only. Except debentures, remaining all are taken over at book value only. I mean to say, the total worth of assets are 2315 and 1588. And the total worth of liabilities, if you know the acquisition price of the 13% debentures, you can adopt the agreed value, remaining all are at book values only. Then you will get the NAV, right? That NAV should be need to compare with purchase consideration. If PC is greater than NAV, then you will consider it as a goodwill. Sir, if PC is less than NAV, then you will consider it as capital reserve. So all such issues I am going to discuss through printed solution again. Please concentrate. Come here, where you will, all of you please come here, guys. Now first, we already calculated the purchase consideration and net payments method. We got 1800 lakhs. Here we got 1111.25 lakhs. Same. Then he compared with NAV. To know the capital reserve, we are comparing the net asset value of the business takeover with the purchase consideration. Sir, assets are same as like balance sheet. If you observe in balance sheet, what are the totals given? In balance sheet, what are the totals given? Which are 23151588. 23151588 is the total assets. But he wrote individually. Less liabilities taken over. First, out of the liabilities, at which value debentures are taken over? 13 lakhs divided by 15%. How much it is? 13 lakhs divided by 15%. I got 86.67 lakhs. He put the same figure. Now 7,28,000, 7.28 lakh divided by 15%, which is 48.53. He put 48.53. Remaining liabilities are all are at book value. These all are at book value only. Remaining all are at book value only. I mean, unsecured loan, creditors, and bills payable. All are they are recorded at book value only. Then they got net assets taken over at 1,000 sorry, 1 second. Here the jumbling happened. Purchase consideration is 1,800 and net assets taken over is at 2083.33. If you compare PC with NAV, here the purchase consideration is less than NAV. That's why capital reserve erased. Here also, if you can compare here, guys, purchase consideration is 1111.25 and the net assets taken over is 1504.47. Again, the purchase consideration is less than NAV. That's why again the difference you can derive as a capital reserve. So this is the amount of capital reserve in both the cases. Now you got the capital reserve as well, na? Now you got the capital reserve as well. Capital reserve, how much you got? 283.33 is capital reserve. For the other company is 393.22. With this information, you can start the balance sheet directly. Now, all of you, please concentrate how to draft the balance sheet. Sir, whenever they are asked in the question or whenever they are asked in the examination, you need to prepare balance sheet. Don't directly put the balance sheet. Don't directly want to prepare the balance sheet, because before making preparation of the balance sheet, you should ready with your figures like how much purchase consideration I am paying, in the form of equity shares how much, in the form of preference shares how much, and is it goodwill or capital reserve which is going to arise. Such things put in your mind, then you can start the balance sheet from your end. Now it's very easy. I don't want to tell the entire balance sheet. I will only tell two things. Sir, equity share capital, how much I should consider, sir? On behalf of 35,000, 10 rupees will go to capital, 25 rupees will go to securities premium. Here also in the 35, 10 rupees will go to the capital, 25 rupees will go to the premium. Next, in case of preference shares, out of this 125, 100 rupees will goes to the preference share capital, 25 rupees will go to the securities premium. Here also same, 100 rupees capital, 25 rupees premium. Like this, you need to segregate. I mean to say 10 lakh into 4 into 10 rupees is the capital, 10 lakh into 4 into 25 is the premium. Like this, you need to calculate amount put under share capital, amount put under securities premium. Am I right? Once if it is over, then you need to start with reserves and surplus. Please all of you concentrate. Reserves and surplus is here important. Sir, what I should need to do? Sir, this is amalgamation in the nature of purchase. That's why reserves and surplus of the selling companies you should not consider. That means all these reserves and surplus is not coming into the books of the purchasing company. Ignore revaluation reserve, ignore the general reserve. But investment allowance reserve need to be maintained in the books of purchasing company. 80 plus 40, 120 you need to maintain under reserves and surplus. One of the statutory reserve is 120. But at the same time, immediately you need to maintain amalgamation adjustment account as well with a negative figure. The entry is amalgamation adjustment to investment allowance reserve. Investment allowance reserve is a positive figure. Amalgamation adjustment account is a negative figure. Am I right? Next, apart from this, securities premium also you need to record. Just now you derived the securities premium, the entire securities premium you need to record. Apart from that, while comparing PC with NAV, you derived the capital reserve. Such capital reserve also you can add it, you can represent here. Then you will get total of the reserves and surplus. Apart from this, all the assets are line by line addition. All assets are simply add the both the things. Why? All assets are taken over. All assets are taken over at book values. Now, except debentures, remaining all liabilities are also taken over at book values. What is the taken over value of the debentures? You know already. We calculated in form of NAV. So under the NAV, debentures we taken over at 86.67 plus 48.53. If you can add it, then you will get the debentures as well. Then balance sheet will be automatically tallied. Do you agree, guys, all of you? So I'm not completely doing the problem, but I explained how to do the problem. That's it. Okay. Right. So still I have 10 minutes time, guys. As I assured you, I will give time for the doubts clarification. Can you please tell me, guys, all of your doubts one by one? Let me check. I'll open the query box. So if you are having any doubts, please let me know quickly here. Yes, sir. All clear. Okay, sir. Got it. Got it. Yes. Okay, fine. Next. Okay, no doubts. So one person is asking, sir, all clear, but sir, please clarify why we are using preference shares in problem number 9 as in merger. Only equity shares are used. What is the problem number 9? Already over long back. Now let me go back. Problem number 9999. Yeah, in problem number 9, what's your doubt, ma? Why we are using preference shares in problem number 9 as in merger, only equity shares are used. Sir, here you need to understand one thing. This problem is a combination problem. The same problem we are conducting amalgamation in the nature of merger, amalgamation in the nature of purchase. Just he is asking that assumption that on the basis of assumption that don't apply the virginal provisions. Just a single problem he is given that you can assume if the amalgamation in the nature of merger. But sir, is it really merger? No. Why? How a single amalgamation, both it acts as a merger as well as purchase? How it will work out? Can you please tell me practically? Either the amalgamation is amalgamation in the nature of merger or amalgamation in the nature of purchase. Only one will occur. But this is only for academic purpose. Your point is correct. I too agree. Sir, in case of amalgamation in the nature of merger, only the purchase consideration in the form of fully paid up equity shares only. Okay. I too agree. But why you are issuing preference shares to the preference shareholders of selling company? Why you are issuing preference shares? If you ask the question, there is no answer from my side. The reason is just he is telling that make assumption. Don't go to the roots of the provision. This is only for academic purpose. But if you go to the practically, you are right. In case of merger, we cannot issue the preference shares as a PC because the entire PC should be only in the form of fully paid up equity shares only. Okay. Hope your doubt is cleared, ma. This is only for academic purpose, but in the merger, we should only consider equity shares. Okay. Next. Sir, you are explained very well. All clear. Thank you, ma. Sir, how to find out whether method is net assets method or intrinsic value method? Okay. I told you both are same actually. There is no difference. But one thing you have to understand here. What is that? I will explain here. Please concentrate. For example, in the problem, it is clearly given that, sir, selling company is here, purchasing company is here. If the discussion he is discussing per share basis they are issuing. I mean to say, sir, selling company per share is 20 rupees, sir. Purchasing company per share is 30 rupees, sir. Now, purchasing company is going to issue equity shares to the selling company on the basis of this 20 rupees value. Then you can consider this as an intrinsic value method. Sir, per share values are not given. Per share values are not yet given. Then there is no requirement of calculation of intrinsic value method. And moreover, net payments method is also not suitable. Why? Because amount payable to equity shareholders you are unable to ascertain. Then you can apply the net asset value method. Very simple. Sir, how can I differentiate whether NAV method is suitable or the intrinsic value method is suitable? For the purpose of calculation of PC in case of intrinsic value method is number of equity shares in selling company into intrinsic value per share in selling company. If we given intrinsic value per share in the selling company, we can directly apply the intrinsic value method. But he was not given the intrinsic value per share in the selling company, then you can apply the net asset value method. And moreover, you should need to remember one thing. If he is asked that PC should be recorded par value, then number of equity shares in the selling company into intrinsic value per share in selling company divided by intrinsic value per share in the purchasing company, you need to divide. Then you will get number of equity shares issued as PC. Then you can multiply with the face value per share. Then you got PC is recorded at par value. Once you will get number of shares issued as PC, if you can multiply with the face value, then you will get PC is recorded at par value. That type of questions are also regularly testing in the examination. Please bear in your mind. Okay. Next out. Sir, in problem number 1, equity shares in cash. Why not transfer to equity shareholder account? Sorry, I can't understand. Problem number 1, equity shares in cash. Equity shares in cash means? So can you please make it clear somewhat? Can you please throw some light on your query, Amma? Sir, yes, sir. Why in merger we use preference share, only equity share used? So I told the same answer. I already given the answer. That is only for academic purpose. Sir, in last problem, how to calculate reserve? Last problem, how to calculate reserve? Na? Which reserve? You are asking about the capital reserve, na? Sir, capital reserve is going to calculate while comparing PC with NAV. Hope you are asking about the capital reserve. PC should be compared with NAV. The remaining reserves, investment relevance reserve is a statutory reserve. Amalgamation adjustment account is a negative figure. Securities premium, you know automatically by checking the PC. The amount paid over and above the face value is the securities premium. Okay. Yes, that is assumption. Hope now it is clear to you. Sir, in better best problem, in our study material, all accounts are closed. Can we only close realization, best limited and shareholders account? Sir, it is not related to all accounts are closed or all accounts are not closed. That is not the issue, guys. Okay. I mean to say, as a systematic basis, assets and liabilities which are taken over only you can transfer to the realization account. Which are not taken over, no need to transfer to the realization. I will tell you the reason. The method they adopted in the study material is correct. The method we adopted is also correct. What is the difference? You know what they will do. For example, if this is a realization account, let us assume, sir, plant and machinery is 10 lakhs, which is not taken over by the purchasing company. Just I am assuming this plant and machinery is not taken over by the purchasing company. Now I am realizing it in the outside market. I am getting 12 lakhs. Now I can deal this situation in two ways. One situation we already discussed. You can open separate plant and machinery account. Opening balance is 10 lakhs. Now you realize 12 lakhs. 2 lakhs is the profit. Such 2 lakh profit you can transfer to realization. That is one method. Another method is you can transfer plant and machinery book value to the realization directly. Now sale proceeds you are getting 12 lakhs. Na? Such 12 lakhs you are putting under the credit. The net difference is how much? Which is 2 lakhs. Again 2 lakhs only you are making under the realization. The same thing I am transferring the 2 lakhs only to the realization. Both are same. That's why which account need to be transferred to realization, which account don't need to transfer to realization, no need to think. Both are same. But as a process, for the purpose of uniformity, assets and liabilities which are taken over with the purchasing company, I will transfer to realization. Remaining, I will open it separately. Then the net effect, I will again make it transfer to the realization account. The same thing would happen in case of partnership accounts also. In partnership accounts also, you will open such accounts. You can made it through transferring to realization account, or you can open it separately as well. Okay. Next. Sir, does amalgamation in the nature of merger is external reconstruction? Absolutely. Why not? In case of external reconstruction, what happened? The new company is ready to take over all the assets and liabilities. Am I right? The newly incorporated company is established only for the purpose of takeover of existing company. Yes, you are right, ma. So after calculating number of shares, always we have to multiply by face value. No, that is depending upon the problem information. After calculating the number of shares, if purchasing company is going to issue such shares with other than face value, then you should multiply with issue price. If the purchasing company is issued at face value, then you should multiply with face value. Purchasing company is issued at other than face value, but in the problem it is given that PC should be recorded par value, then at that point of time you should multiply with face value. 3 situations I told. After calculating number of shares issued as PC, in the problem it is given that purchasing company issued such shares at issue price, then you can multiply with issue price. No. In the problem it is clearly given that purchasing company is issued such shares at face value, then you can multiply with face value. And the third case is, in the problem it is given that PC is recorded par value, but purchasing company issued shares at issue price, but still you need to multiply with face value. Very good, Outma. All clear, sir. Thank you for your efforts. Okay, fine. Thank you, Nana. Sir, if we adopt different method, will it make any difference like net payments method and net asset method? Sorry, I can't understand you. Just give clear-cut question. Sir, is number of shares always calculated by dividing by face value per share? Again, I am telling you, Sir, again, I'm telling you, how will you get the number of shares? It is completely depending upon the question. In the question, if you given the issue price, then the total PC divided by issue price, you will get the number of equity shares. In the question, it is clearly given that purchasing company issuing the shares at face value, then you will get the number of shares, total amount of PC divided by face value per share. That's why don't ask the question, sir, whether can we divide with face value, can we divide with issue price, is depending upon the information given in the question. Hope you understand. Okay, guys. Hope all of your major doubts I clarified. So successfully I completed the chapter amalgamation. From the next lecture onwards, we are going to entering internal reconstruction. I already thrown some light, very basic part regarding internal reconstruction. We already discussed as an intro part to amalgamation. In detail explanation, we are going to discuss from the next lecture onwards. Until you can revise the concept of amalgamation, still if you have any doubt, you can ask at any point of time. Bye-bye, guys. Have a nice day.